Constantinople, 1845. Theodore Baltazzi, Venetian by origin, Ottoman by residence, lender by profession, is sitting across from the Sultan's finance ministers. The treasury is insolvent. Currency is collapsing. The state needs cash by the end of the month. Baltazzi provides it. He has done this before. He will do it again next month. He is borrowing the money in Paris and London at 6% and lending it to the imperial treasury at over 20%. The ministers know the rate. They sign anyway, because they have no other option. The trap was not set in 1875 when the empire declared default. It was set here. This is not fiction. This was Constantinople, 1845. Here is what blows people's minds. The Ottoman bankruptcy story most people carry around begins with foreign creditors. London, Paris, bond markets. The humiliating default of 1875. The Muharrem Decree of December 20th, 1881. European control, but the forensic record points somewhere earlier and closer, before the famous default, before the decree. Before the official loss of fiscal autonomy became visible, the empire was already living month to month, not metaphorically, operationally. That is the key inversion of this story. The first decisive loss was not the day Europeans imposed terms on a broken state. It was the earlier moment when the treasury could not clear its own obligations without returning to the same creditor circle for another short-term advance. Again, and again. And Theodore Baltazzi sat inside that circle. That matters because a state in long-term debt still has room to bargain. A state in monthly rollover dependency does not. If payroll, provisioning, arrears, and exchange operations all depend on cash arriving before the month closes, then the man who controls that bridge does not merely lend to the treasury, he prices its survival. This is the part the official history smooths over. It treats the Galata bankers as secondary intermediaries who exploited weakness on the margins. But if the treasury cannot function without their paper, their contacts, and their timing, then they are not on the margins. They are the mechanism. And once you see that, 1875 stops looking like the beginning of Ottoman financial subordination. It starts looking like the public ceremony. The real transfer had already begun. If you want to understand why Theodore Baltazzi could name the price, you have to leave the palace and cross the Golden Horn. Go to Galata, not the ceremonial city, the working one. Counting houses, exchange dealers, merchant ledgers, men who knew by the afternoon what the treasury would be short by the morning. That world did not simply appear when the Ottoman state became weak. It had already been built. And the same families who helped build it were the families the state later depended on when cash ran out. The Baltazzis sat among them, alongside names like Allione, Commando, and Zarify in the Galata commercial system, and in the empire's early exchange stabilization efforts. This is where the story becomes more precise. The Galata bankers were not just lenders. They were seris, money handlers, brokers between currencies, tax receipts, treasury promises, provincial remittances, and immediate cash. They lived inside the plumbing of the state. If a provincial payment arrived late, they knew. If the kami lost credibility, they knew. If the treasury needed silver now but only had paper promises and future taxes, they knew that too, and that knowledge was not academic. It was billable. Here is the mistake many histories make. They treat dependency as if it began when the Ottoman government started borrowing abroad in size. But by then, the domestic dependency already existed. The foreign borrowing machine did not replace the Galata system. It rested on it. Same city, same houses, often the same men, because a government does not become capturable only when it owes money. It becomes capturable when someone else manages the timing mismatch between what it owes today and what it might collect next month. That mismatch was the business model. And once that model hardens, The lender's advantage compounds, not only because he has capital, because he has sequence. He sees the shortage before anyone outside the room can price it. He knows whether this month's advance is exceptional, or whether next month will require another. He knows which ministry is bluffing, which revenue stream is already spoken for, which emergency is real. Theodore Baltazzi was not powerful despite this architecture. He was powerful because of it. That is why institutions like the Der Audit Bank matter in this story. Not as decorative modernization, as proof that the line between private intermediary and public necessity was getting thinner. Formal names appeared, corporate forms appeared, but the underlying fact did not change. The empire's day-to-day financial metabolism still ran through a narrow creditor class clustered in Galata. So when the treasury walked in asking for rescue, it was not entering a market. It was returning to a system designed by the people it needed most. And systems like that do not charge neutral prices. So what exactly was Theodore Baltazzi selling? Cash, yes. Timing, yes. But above all, he was selling privileged knowledge of desperation. This is the number many tellings glide past. The Galata bankers could borrow in European markets at roughly 6 to 7%, then relend to the Ottoman Treasury at rates above 20%. That spread, 13, sometimes 14 points, is the forensic center of gravity in this story. Not a detail. The detail, because you have to ask the obvious question. Was that really risk? Some of it was. The empire was unstable. Currency was fragile. Collection was uneven. Politics mattered. Of course they were not lending to Prussia, but risk alone does not explain a gap like that. Information does. The men in London and Paris who supplied funds upstream did not sit inside the Ottoman month. They did not watch the Treasury's cash window closing in real time. They did not know which obligations could be delayed and which would trigger immediate disorder. They did not know when paper currency pressure would turn into a credibility event by the bazaar opening. The Galata intermediaries knew all of that, and they priced that proximity. This is where the mechanism becomes uncomfortable. The spread was not merely compensation for uncertainty. It was rent extracted by people who occupied the only position from which uncertainty could be translated into immediate survival. If you are the only class that can see the shortfall, bridge the shortfall, and decide how punitive the bridge will be, you are not just a lender. You are the toll gate. Agat Pasha matters here too, not as a side character, as a sign that Ottoman fiscal administration itself was changing under pressure. The introduction of compound interest accounting into the system meant the state was not just paying dearly, it was beginning to record, formalize, and internalize the mathematics of recurring dependence. The debt burden stopped being episodic. It became cumulative, layered, self-reinforcing, and this is why Theodore Baltazzi has to stay at the center of the story. Picture him in Constantinople in 1845. He knows the ministers can read the rate. He knows they dislike the rate. He knows they may denounce men like him in public. None of that matters, because he also knows something more important. The Treasury needs money now, not after a diplomatic negotiation, not after a bond roadshow, not after tax collections normalize. Now, that changes the moral language of the transaction. Publicly, this can still be described as emergency finance. Privately, it is something harsher. A state paying whatever it must to keep the month intact. And once a government gets used to financing itself like that, the interest charge is no longer the deepest problem. The habit is, and then the mechanism hardens. What Theodore Baltazzi represented in the 1840s was intimate power, personal networks, monthly rescues, negotiation across a table. But by the 1860s, that older Galata advantage begins to migrate into institutional form, and that is where the trap gets harder to escape. In 1864, Aristide Baltazzi co-founds the Société Générale de l'Empire Ottoman alongside interests tied to the Imperial Ottoman Bank, specifically to compete for Ottoman government borrowing business. That sounds technical, It is not. It means the intermediary class is no longer merely brokering state distress. It is incorporating it. That is the turn. Because once the lending relationship sits inside a formal company structure, several things change at once. The creditor can hold government obligations more cleanly. It can compete in auctions with better information than outside rivals. It can convert what used to be episodic emergency leverage into repeatable institutional leverage. And it can do all of this while presenting itself not as a court-connected fixer, but as modern finance. Same power, better clothes. This is where Aristide Baltazzi matters. Not because he replaced Theodore, because he reveals the next stage of the same logic. Theodore shows you the monthly dependency in raw form. Aristide shows you what happens when that dependency acquires balance sheets, legal wrappers, and prestige. And that creates a deeper problem for the state. How do you bargain with your creditors when your creditors are also your bankers, your exchange managers, your auction participants, and in some cases the people most capable of telling the wider market whether your paper is still credible? You do not. You adjust to them. Here is the detail most people never hear. The real danger was never just that the Ottoman state borrowed at bad rates. States do that all through history. The deeper danger was that the same creditor circle kept extending its role across the entire chain of dependence. Cash advances, exchange operations, institutional lending, debt placement, collateral structures. The chain closed. So return to Theodore Baltazzi for a moment. In 1845, he is still a man across the table. By 1864, the world he helped establish is becoming corporate, layered, and far more durable. What began as a recurring emergency facility is now becoming a permanent architecture. That matters because permanent architectures outlive ministers. They outlive policy shifts. They even outlive outrage. And once distress becomes an institution, default is no longer the first moment of loss. It is the first moment the public notices. So who actually paid for this machine? Not the Galata insiders. They were positioned on both sides of the flow. They had upstream access to European funding, downstream control over Ottoman liquidity, and far better visibility into the Treasury's condition than anyone buying the paper from a distance. The cost landed elsewhere. It landed on the provincial taxpayer, whose future revenue was already being leaned on before it was collected. It landed on holders of Kaime, whose paper claims weakened as confidence weakened, and it landed on smaller British and French bondholders who bought Ottoman obligations as if sovereign form meant sovereign control, while insiders in Constantinople understood that the Treasury was already living hand to mouth. That distinction matters. Nominal wealth is not usable wealth. A bond certificate can look secure. A paper note can still circulate. A tax claim can still exist in an account book. But if the system behind those claims is being refinanced 1 month at a time by a narrow lender class, then the real hierarchy of payment has already changed, quietly. This is where the buried lead enters. Most histories present the Muharrem Decree of December 1881 as the decisive foreign imposition, the moment European creditors formalized control over Ottoman revenues through the public debt administration. And yes, that decree mattered. It created a powerful external apparatus that eventually employed thousands. But structurally, the template appears earlier. In November 1879, domestic creditors, the Galata banker circle, had already negotiated a revenue assignment arrangement with the Ottoman Treasury. Before the famous European settlement, before the full colonial vocabulary attached itself to the event, the model was already there. Earmark revenue streams, secure payment by assignment, move beyond promises and into administered collection rights. That is the reframe. The Europeans did not invent the Ottoman technique of fiscal seizure through assigned revenues. They inherited and expanded a domestic version already tested by the empire's own insider creditor class. The so-called six taxes structure later associated with the Ottoman public debt administration did not emerge from nowhere. It had a prototype, and Theodore Baltazzi helps explain why. Because if you spend decades teaching a treasury to survive through dependency, you also teach it the next step, that future revenues are not public resources first. They are collateral. That is the true human cost of this system. By the time the wider public sees the formal decree, the ranking has already been decided. You pay taxes. You hold paper. You trust the sovereign seal, but someone else stands first in line. Now bring the mechanism forward, not to London, to Islamabad. In 2023 and 2024, Pakistan's government was borrowing domestically at punishing rates while effectively shut out from easy external market financing. The State Bank of Pakistan's policy rate reached 22% in June 2023, then 23% from late June 2023. There's several decisions into 2024 before cuts began later in 2024. Domestic banks remained the main buyers of government paper, much of it short-term or floating rate, while interest payments absorbed an extraordinary share of federal revenue, as documented in IMF country reporting and related data. That is not the Ottoman Empire, but the mechanism rhymes, because this is the pattern. When the state cannot fund itself externally on tolerable terms, it turns inward. When it turns inward under pressure, the domestic lender class gains leverage. When that leverage sits inside rollover dependency, price stops being a neutral market signal. It becomes a power relationship. And that brings you back to Theodore Baltazzi. What he understood in Constantinople in 1845 was simple. Brutal, but simple. A treasury that must return every month to the same creditor class is no longer negotiating from sovereignty. It is negotiating from need. The decree comes later. The ceremony comes later. The flags, the commissions, the foreign administrators, the legal language later. First comes the month, then the next month, then the loss of choice. By the time the Muharrem decree arrived on December 20th, 1881, the formal structure only acknowledged what the operating reality had already become. An empire that had once taxed at its own name now watched dedicated revenues flow through a creditor-controlled apparatus that would eventually employ around 9,000 people, more than the finance ministry itself by some accounts. So the choice is binary. Recognize the mechanism while dependency is still episodic, or negotiate after it becomes structural. The sultans chose second, and history recorded the price.